Howdy there, folks. Welcome into today's video. It's a buy one, get one free here today. Two videos for me to react to. First one up here. I still think we are going into recession, says Short Hills Capital Steve Weiss. So we'll hear what he has to say, share my perspective on that video there. Okay, second video to react to is the Professor Jeremy Siegel. Market momentum is still there. I want to hear what he has to say about the market and kind of his view. So yeah, looking forward to getting into these. As always, folks, I appreciate y'all being here. Thank you every single person that subscribed. I appreciate y'all. We're approaching 30,000 subscribers now here on the channel, getting pretty darn close. So also, just so you guys know, July 4th, we're going to open up the $10 Patreon tier so you can see the moves I'm making out there. If you want access to that on July 4th when we open up the tier for the day, then go ahead and check out pinned comment down there, enter in your email, and we'll send you over the link for access as soon as that drops on July 4th, okay? All right, guys, let's get into this.
First, I think he deserves it on what you think lies ahead. Not that your positioning was so perfect, but your call has been good. So now what?
So I'm sticking with the call. I want to say something really quickly. I mean, Steve's got a different opinion, but it's not like he's an idiot. It's not. I mean, there's rationality to the thesis of 500 basis.
I feel like this dude's always taking like subliminal shots over here and vice versa. You know what I mean? Like, don't even say that about me, man. Like, don't say like, well, he's not an idiot. Like, I don't know. Like, that seems like a backhanded compliment if I ever heard one, man.
Points of rate hikes should have a dramatic effect. There's rationality to the idea that the yield curve is a predictor. However, there are other perspectives, and my perspective, Scott and viewers, has always come from the point of view of what the companies are saying. Doesn't mean they're always right, but right now, companies pretty much across the board are saying things look good. Maybe not so much in retail, but think about what the airlines are saying. Think about what casinos are saying. Think about what steel companies like Nucor pre-announced, a couple of weeks ago. The companies see a more positive outlook, Scott, than the macroeconomists, and you see that in estimates from the top down for S&P 500 earnings, which continue to find new lows. While if you go into individual stock estimates, like General Motors, like Alaska Airlines, I won't do all of them, like Cleveland Cliffs, right? Mm-hmm. Those keep going up. That disconnect, okay, Scott, this is the most important part. That disconnect between top down and bottom up gets resolved with second quarter earnings. One's proven right and one's proven wrong. I'm going with the companies. I'm staying with my cyclicals.
Okay, so Weiss, I give you the ball next. Mm-hmm. Because I think that's the right way to go here. What do you think you missed here in the first half? And are you at the point now of looking at a different trend in the market and thinking that it's time to change your overall view?
Look, what I missed were six things. Apple, NVIDIA, Microsoft, Meta, and Amazon, I guess.
Sure, but you thought the economy would be worse off than it is today. Right. You thought the consumer would probably be worse off than it is today. You thought that the market certainly wouldn't be where it is today.
No, that's absolutely true. But again, as I said the other day, the average stock, maybe it's up a little more, but when I spoke the other day, it was about 3%.
It's up 6%. Equal weight S&P 500.
Yeah. So I didn't miss much in terms of the broad market. Now, with those stocks, I do own Microsoft, I do own Amazon. Microsoft's actually my largest position. So what I missed is that it's a new generation of investors. And that's really what it comes down to. That just, this time's different. I think every time's different. I don't think, it's never any different. I never bought into that. The facts are always different. Maybe the conclusion is long enough time is different, but this time it's all different.
Is your view then different now for the second half because of all that?
Yeah, I think it is. I think it is because, and I'm picking up things here and there. But here's why. I mean, Powell came out, market doesn't care. EU came out, market doesn't care. Rates are where they are. Market just doesn't care. Maybe that's the right thing to do since markets go up all the time, with the exception of that brief period of time where they don't, sometimes longer than brief. But yeah, so it does change my view. I still think that we're going towards a recession. And the better we do on days like today, and seeing GDP go up, and as long as the labor market stays resilient and as inflation stays sticky, the bulls are going to see the glass half filled no matter what.
I mean, look, the CNBC Delivering Alpha Investor Survey on the markets right now, do you believe we're either in a new bull market or a bear market rally? Liz Young, 61% told us they think we've entered a new bull market. So there are a lot more believers, so to speak, today than there have been over the last many months. They sense that there's been a trend change, and it's meaningful, and it could be lasting.
Yeah, so my opinion on recession, no recession, okay? I'll tell you this. The longer, and this is important, okay? The longer rates stay at an elevated place, let's say Fed funds 5 something, I think the higher the probability is we're going to eventually go into a recession, right? Eventually, if rates are high enough for long enough, that will catch up to the economy and ultimately hurt the economy. It hasn't yet. I mean, we've made it through so far. Unemployment's still very low. Things are still trucking along. But at some point in time, it's undefeated. I mean, just to be honest, every single time after the Fed raises rates very, very high, it's undefeated. It's never not happened. You've had a recession follow. It's just a question of how long does it take, right? Is it like, 6 months after, 12 months, 18 months, 24 months? So that's the thing that worries me a little bit. If the Fed keeps rates at an elevated place for a long period of time, eventually that will catch up and it will break more things in the system. And eventually there'll be some systemic problems that will cause a lot more damage. That's kind of my opinion and perspective. But as of right now, at least, the economy is on decent footing. Inflation's come much under control. We have real wages that are starting to get to interesting places finally. So there's definitely some exciting things here, at least in the short term. Where things are at 2 years from now, it remains to be seen. But at least here in the short term. And it is, I will say, it's a confusing time period if you're trying to predict the economy. Because, it's like, are we in an 06, 07 type time right now? Is this like 08 and we're just, getting ready and getting close to, things are about to tank? Or are we not in any of those? Are we actually in like a 2002, 2003 right now, where you were coming out of the tech bubble and stocks started to go up very nicely again, the economy stayed very good? And we'll see. I think we'll know a lot more 6 months from now, let's put it that way. Market momentum is still there. The professor, Jeremy Siegel, let's hear what he has to say.
All right, we're putting a good first half in the books. Does it carry over to the second half? What do you think?
Wow. I mean, my forecast at the beginning of the year was 15%, and we just kind of today just crossed over that for the whole year. And really, the economic data, the economic activity, real growth has certainly exceeded the Fed's expectations, everyone's expectations. And I think what's going on with tech investors, it's a win-win for them. They say, listen, it's a long asset. If we have a recession, tech is mostly immune. And if we have a recession, the Fed will stop raising interest rates, maybe lower interest rates. That's really good for our long-lived.
So the first half of the year is officially in the books. Let's see how some of these big techs fared now that we got the official first half of the year done. So let's go to my big tech watch list here. And let's see. So Uber Booba stock year to date, 70%. Congratulations, Uber shareholders. Oracle, 42%. Apple, 55 flipping flapjack and percent for a company that's in decline factually. Amazon, 51% move. PayPal, buy the dip and never trip. Micron, that's actually a pretty good performance from Micron on the first half of the year. Intuit, 17%. Intuit's a bit of a lagger. Q's up 38%. Mr. Softy, 42%. Meta, 130%. Wow, what a move. Shopify, 81%. Palo Alto Networks, 84%. NVIDIA, the biggest winner of all the chicken dinners, 195% gain for NVIDIA. Oh my gosh. Adobe, 45%. Google McDougal, 34%. Snowflake, 29%. Netflix, 49%. Salesforce, 56%. Tesla, Maesla, congrats fellow Tesla bulls, 142%. And I can tell you it's a good time to have Tesla and Meta as your two biggest positions in your public account. 25% Intel and AMD, 77%. Congratulations, AMD shareholders. Some absolutely massive moves. What do I think about big tech for the back half of this year? I'll tell you what I think about big tech for the back half of this year. I think You're going to have certain stocks that have very exciting stories that they could continue their runs on. I'm speaking about Meta specifically. I'm speaking about Amazon specifically. I'm speaking about PayPal really amping things up in the second half of this year. I wouldn't be surprised if PayPal is one of the better performing stocks in the second half of the year in terms of kind of versus the big techs. I think there's going to be some other stocks that have some big questions to answer. I think Apple's the first one I think about. We got a business there that's factually in decline, and they need to turn it around. When you got a stock that's soaring to all-time highs, the stock's breaking all-time highs, you better come through with the numbers, because we know that Meta Pro thing is not going to save the company anytime soon, right? In terms of if that ever gets to big production, we're talking about that's years from now. So you're in kind of this state with Apple where you're still very dependent upon iPhone. And what are these iPhone numbers coming in at? Is iPhone 14 really selling like that? Is iPhone 15 going to be the next banger product for the company? Based upon what I've seen, it doesn't look like it. So Apple's going to have a lot of questions to answer, right? Google McDougal has a lot of questions to answer kind of on the legal front. They're going through a lot of stuff with the government right now. So that one's kind of a question mark. So I think we're going to enter in a divergence of big tech, where it's kind of like, all boats have been lifted by the rising tide here. I think the second half of this year you're going to find out who the real winners of big tech are right now and who the ones that were just faking it. And we will see that play out in the next 6 months, in my personal opinion. We'll see how it all shakes out. Maybe it's just another, straight up and all the stocks go up another 20, 30, 40, 50, 60%. I just don't think that's going to happen in the back half of this year. I think it's going to be a winners and losers market when it comes to big tech specifically. I do think there's a potential, especially if the economy stays on solid footing, let's call it the next 6 months, I do think there's a potential where all smalls pretty much can rise. All mids can pretty much rise. So maybe you get some rotation to some of those, okay?
Assets that we have, so everyone piling into tech because they say that it's a win-win no matter what happens to the economy. Of course, what's happening is the non-tech are selling at 14 and 15 times earnings, and tech is selling at 25, 30, 35 times earnings. So that gap has certainly grown a lot recently and takes into account that scenario. But hey, the beat goes on, and I think the whole market is saying, who's afraid of the big bad Fed?
Yeah. Hey, is the beat going to go on for the second half? I mean, how long can this continue?
Well, it can continue a lot longer. Now, that gets a problem for long-term investors because it's so hard to tell the turn. But really, the momentum is still there. I think if you're a short-term trader, I think it's going to take a real weak economic report or some earnings that really, it's the opposite of what we saw with NVIDIA, really a disappointment to shake it. And by the way, usually it's not one thing. It shakes and then comes back, and then it's usually a second one that says, the tide is turning. And at this particular point, we don't have number one or number two. So one of the oldest sayings in Wall Street, Scott, make the trend your friend.
Yeah.
And
it's a new trend. I mean, the trend has changed, right? As you know, the trend has been up. Do you foresee a catch-up trade? You said tech has been the winner.
Before we go further here, why am I not interested in, let's say, buying put options on NVIDIA as like a hedge, right? Because the stocks run so much, obviously, right? The reason I'm not interested in buying put options on NVIDIA is I'm not so convinced NVIDIA is even going down anytime soon. There's a potential it does if they don't come in with their numbers, but if this company comes in with numbers, has another insanely strong guidance, and I think the one factor a lot of people are overlooking with NVIDIA is that earnings per share and how that could skyrocket. It doesn't seem very attractive to me. Just because the stock's gone up a lot does not mean it's going down anytime soon. So that's why I look at NVIDIA, and at this stage right now, I'm kind of like, there's too many wild cards. When you have a company that just comes in and says we're going to do 60% revenue growth when they were expected to do 6%, it's not a company I'm looking to get in the way of or hedge against or anything like that. It's a whole different business model.
And you pointed to some of these other areas of the market which you think are much cheaper from a valuation standpoint. Is there going to be a catch-up trade where some of these laggards, the financials, the energy stocks, and things like that are going to have a catch-up?
Well, I think there are. I think what's going to happen, if the Fed over-tightens, then I've been warning about the Fed over-tightening. Scott, really confuses me is since the meeting 2.5 weeks ago, every single inflation indicator, including wages, has come in at or below expectations. And yet the rhetoric of the Fed has gotten even more aggressive.
True.
It's like a war on growth. Oh, we can't have this much growth.
Yeah, that's a good point.
And,
Good point.
you know, I think that's a very dangerous way to look at the economy. We want growth in the economy. We want non-inflationary growth. So, you know, I am still saying in the second half, there are more risks on the downside than on the upside. But then again, that whole saying about trends can continue a lot longer for your, you know, I don't see the short run trend breaking at any point soon.
Yeah, I think the Fed's at a, you know, if they want to keep raising, I'm just telling you, it's a huge mistake and they should not keep raising. You look at every single inflation data point you want to look at, specifically, obviously, CPI. I mean, CPI right now is either in the 2s or 3s, right? We have a clear correlation. There's no debate. This is factual. There's no debate. A clear, massive correlation that inflation is crashing right in front of us. And to say, you know what, we're just going to keep raising even though, you know, numbers are starting to get very close to what we want them to be. And even though Fed funds is way above what CPI is really running at right now in reality, you know, that would just be a massive, massive mistake. But you can't assume the Fed won't make a mistake because they just already did, you know, 2 years ago when they kept pumping money out there like crazy and kept rates at zero when it was clear they didn't need to do that anymore, right? And so could they screw up twice? 100% they could. And that's the thing that scares me, you know, and at least keeping me cautious on the market, is understanding we got a Fed that is so backwards looking with their data, they don't foresee anything. They didn't see the massive inflation that every other person running a business saw way before the Fed ever saw it. They don't see the fact that inflation has tanked, even though you can look at backwards looking data and find this. And yet they want to keep potentially raising rates. That would just be a huge mistake. And so, you know, if Jay Powell really wants to cement his history into being like, you know, one of the worst Fed presidents ever, keep raising rates, send the economy into a massive recession, and you will accept 100% blame for that, because then you're going to be in a situation where everybody's going to be looking and saying, dude, inflation was clearly coming down, the economy was staying decent, and then you decided to keep raising rates? Like, what are you thinking when you got CPIs at 3s? You're 1 percentage point away from your 2s, and you're going to keep raising, and you crash the economy. And what happens when you crash the economy, right? Politicians get voted out of office. You have dramatic decisions that end up having to be made around stimulus for the economy, trillions of dollars. Get ready for debt to climb to all-time highs. So my opinion for them, you know, if you want to talk tough, but you better keep rates where they're at for a bit and get ready to lower them sooner rather than later, because, you know, you want to keep raising, you can go ahead and do that. And then you'll have a massive mess to clean up on the other side. And you'll be fully cemented as the worst Fed president in history. That's the bottom line with that. So appreciate y'all joining me as always. Thanks so much, folks. Thanks for being subscribed here. I appreciate y'all. Continue to take advantage of deals out there you see in the market. And make sure you join us for the $10 Patreon tier. That's going to be July 4th. Check out pinned comment down there. Enter in your email, and we'll send over access to that on July 4th. Much love, and have a great day.